The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Before we join Chris Weston from Pepperstone, let's just have a quick look at what other traders are watching out there. Fed Reserve Chair Jay Powell reiterating that the central bank plans to wait for the impacts of tariffs on inflation before lowering interest rates. Now, speaking at a central bank gathering in Portugal, he said, "I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve." The US could reach a trade deal with India. Meanwhile, US Senate Republicans have passed President Trump's tax and spending bill, that big beautiful bill that would slash taxes at expense of social safety net programs while adding $3.3 trillion to national debt. The legislation now heads to the House of Representatives for possible final approval. And in the latest US data, manufacturing remained sluggish in June, with new orders subdued and prices paid for imports creeping higher. The ISM manufacturing PMI edging higher but remaining in contraction. Let's get across all the technicals with Chris Weston from Pepperstone. And Chris, kicking it off with the euro, which is up against the dollar for the 10th session.
Yeah, I mean, it's been a blockbuster. Obviously, a lot of this has to do with the weak US dollar story. And we can talk about that for days, to be honest. I mean, but the euro has been on fire. I mean, we closed out a very, very strong first half of the year. I mean, it was the worst first half of the year for the US dollar since 1973, but the euro, the Swiss franc, and specifically those currencies worked out very nicely in the first half. But as you can see on the technicals here, we're in a beautiful uptrend. We've got a nice channel which is being respected. We've probably hit the top end of the channel right now, and I think that for me just makes it a bit tough to chase now. Putting new capital to work. Would I be buying euro at current spot levels? Probably not. I'll be waiting for a pullback for a better opportunity in this situation. But yeah, there's obviously a sort of a debate at the moment. Is what we've been seeing a structural issue with the US dollar or more cyclical factors? I think it did start with more of a structural issue at the beginning of the year. Obviously, the market had gone into 2025 incredibly long of US dollars across all different structures, in terms of having a massive wall of capital in US equities, $31 trillion of equities, treasuries and credit exposure with very low hedging ratios put in place. I think a lot of those hedges have been put in place now, and that's neutralized some of that US dollar exposure. But now I think we're more sort of driven by structural, by cyclical factors, and we're seeing euro dollar looking much more closely at relative rate differentials. Obviously, people that you just talked about, what Jerome Powell's potentially doing. We've got 20% price for July now for the Fed meeting there. We've got a full price rate cut for September and 2.5 rate cuts by the end of the year, whereas the ECB are getting somewhat more hawkish at the margin. And that's pushed euro dollar up to just under 118. So the technicals really, for me, it's very, very rare that we see euro dollar pushing up for 10 straight sessions. I think since 2000, we've only seen 3 or 4 occurrences if it happened before. So the sample size is irrelevant to the point that I can tell you what's predicted for the 11th session. But I think what that does is it just simply shows you there's absolutely beautiful momentum behind this. And until something structurally changes, I'm a buyer of pullbacks in this pair.
All right, well, everyone's curious as well about the Aussie dollar, which is on a good rally. Tony Sycamore from IG just telling me maybe we get to 67.3. What is the technical showing you?
Yeah, I mean, I'm not going to go out on a limb and give an exact level for a target, because the way that I'm thinking about this is more just when you get a breakout like this, for me, it's just a question of holding. So we're using sort of more of a systematic stop to keep us in the trade and just letting the market run until you get kicked out, essentially. So that could be at Tony's levels. It could be higher. We just don't know. But the whole point of breakouts and trading momentum like this, or even trends, is that you're looking for that big outlier in the distribution, and the art of holding a winner is the hardest part. You can cut your losses easy enough, but holding on to that. But right now, I mean, obviously in this pair, Aussie against the US dollar, I think really where the risk is for me is the relationship it has to other risky assets such as the equity market. And, obviously you've got the S&P breaking to all-time highs. It does look a bit knackered, looks a bit fatigued, and we've started seeing some selling of the Nvidias of this world, and the the mega cap techs, which have really just been the along with the banks, really been the big driver of the S&P in the last week or two. Much more concentrated breadth. But if we start to see people paring back some of those longs in the high tech names, I think that could see the Aussie dollar follow in sympathy, and then maybe we get a failed breakout of those levels that we've seen there. And I think when you're looking at breakout trading and looking for that higher rate of change, those failed breakouts can actually give you can actually be more meaningful in itself, and that tells you that the bulls just don't have the control, and that can where we can look at short positions as well. So a lot of this really does hinge on where the S&P goes to an extent, where the Hang Seng and obviously what vols do. But we'll have to see. But for me, this is broken out. It's a dollar play there, but we'll see if this can kick, and I hope it does. All
right, well, let's look at the S&P 500 easing from those records overnight. You're saying though, focus here on the golden cross.
Well, actually, I'm saying don't focus on the golden cross, because I think but the thing is I've had a few clients call up this morning and say we've got golden cross. I've had a few people seeing the headline writers talking about it this morning, and I think let's go back to history. I mean, first of all, when we're looking at anything to do with repetition of patterns and behaviours, is we want a decent sample size. Otherwise, it's statistically insignificant. And really, since the year 2000, we've only seen 11 other occurrences of these golden crosses, i.e. the 50-day moving average crossing over the 200-day moving average. And so that's an irrelevant sample size in the first place. One thing it does tell you is when we have seen these developments, 50 days later, the index is actually up it's up 9 of those times, so a strike rate of 83%. So I think that just tells you that the system is set up for long positions. The market does typically go up, and so buying weakness has been a very, very good trade since 2009. I think the index is up over 800%. So it goes to show that the golden cross has worked, but that's just a situation of price. But I think a lot's changed now. Obviously, we live in a Trumpian world where he can move markets on a dime with one social post. I mean, 80% of the flow in the S&P now is done by high frequency trading, and 0 days to expiry is over 50% of the notional. So it's a very short term focused market. I think you go back to 2000, things have changed a lot in terms of market structure. But I think one thing is clear for me. So I wouldn't look at the golden cross. Is my point. Is it things have changed a lot. It's a very slow moving lagging indicator in a market that's very fast moving. I'd actually be looking at much more shorter term moving averages if you want to use that as an exit signal. But right now we're in a market where I haven't been given a sell signal. We're still long. But I think obviously people may cut back on some of those long positions going into payrolls. We'll have to see how that goes. But my base case is that we do get a market-friendly situation, which would be payrolls above 100,000, unemployment rate 4.3%. And that sort of just keeps this idea that the Fed could be looking to cut rates in July, but most probably in September. We've got 2 rates in there. It's not going to be too hot. I think if we were to see a payrolls number below 80,000, unemployment rate above 4.5%, then I think the equity market could go down, because I think the labour market's so important to this bull market that we've been seeing. But for now, we've got one day affair, but market's still got a love affair with AI. It's very much in vogue as we go into the earnings season. Volatility is still very low in the market. And I still like this high. We haven't been given an exit signal, but obviously watching it very closely.
All right, Chris, thank you as always. Chris Weston there from Pepperstone. That does it for this edition of The Trade. Be sure to join us next time.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.